10,000 years ago, trade was everywhere. Human beings grew crops, built settlements, and forged communities, all without a single coin, dollar bill, or bank. The moment people settled down, they faced a stark reality. What you have is rarely everything you need. A farmer grows plenty of wheat, but he still requires tools, clothing, and shelter. To solve this imbalance of resources, early communities relied on barter. You have grain, I have fish. We swap. It was an elegant system of direct exchange. We often think of commerce as a byproduct of money. The drive to trade, to give something of yours to secure something you lack, is an ingrained human instinct that operated for thousands of years before currency existed. This physical landscape, these small, clustered, mud brick structures, dictated exactly how early trade functioned. In a population of 30 or 40 people, direct exchange runs smoothly. The baker knows the blacksmith, and the blacksmith knows the farmer. It operated as a closed network of trust. Even if you did not have exactly what I needed today, personal relationships and social accountability meant I could give you grain now, knowing you would owe me a favor later. That localized trust network fractures when a village grows into a city. When you are dealing with thousands of strangers, you can no longer rely on memory and social ties to guarantee a future exchange. As societies expanded their populations, they hit a hard limit. To keep growing, they had to invent a new technological system capable of scaling that economic trust across entire cities. Economists call the central flaw of direct exchange the double coincidence of wants. Direct trade requires strict conditions. You must find someone who has what you want and wants what you have. If the sandal maker wants fish instead of wheat, the chain grows longer. Getting simple shoes becomes a massive, exhausting puzzle. As markets grew more complex, relying strictly on direct swaps became an active barrier, preventing trade from happening at all. Faced with gridlock, entirely disconnected cultures around the world arrived at the exact same improvised workaround. They identified a single object that everyone desired and used it as a proxy for all other trades. These proxies are known as commodity money. Along the eastern seaboard, Native American tribes crafted wampum belts from shells. European colonists adopted them, and Massachusetts legally recognized them for settling debts. Across the Atlantic, West Africa used a separate shell-based system. These cowrie shells functioned as a reliable medium of exchange for over 2 millennia. This cuneiform tablet shows how ancient Mesopotamia relied on agriculture to solve the trade problem. Barley was weighed out as a standardized unit to pay laborers and settle accounts. This illustration from colonial Virginia shows workers cultivating tobacco, a crop that successfully carried on this practice of using agricultural yields as legal tender well into the 1700s. Humanity's first universal language of value did not require a government mint. Societies built it by harvesting materials directly from the earth and the sea. These seemingly random objects functioned effectively because they shared a highly specific set of physical properties. To work as currency, an object must be desirable, it must be durable to survive storage, and divisible for small transactions. Finally, it must be easily portable to bring to market, and instantly recognizable so no authenticity is questioned. Salt fulfilled every one of these 5 requirements. Because it was essential for preserving food, its high demand drove industrial-scale harvesting across the ancient world. Roman troops were compensated with salt rations. That specific military practice is where the modern English word salary, derived from the Latin salarium, comes from. The concept of working for a regular, guaranteed payment was firmly established thousands of years before anyone ever held a paper bill. Commodity money relieved the gridlock of direct trade, but physical objects carry their own inherent limitations. A cow is an incredibly inefficient medium of exchange. You cannot easily transport a herd to market, and you certainly cannot divide an ox in half to make change for a loaf of bread. Consumables like salt and tobacco present a different risk. The moment you season your food or smoke a pipe, your capital vanishes. A growing economy requires a method to preserve purchasing power over time. That is impossible if your savings can rot, die, or be eaten. Civilizations reached a point where they needed a medium of exchange that was physically indestructible and required absolutely no maintenance. They stopped looking at crops and livestock and began searching the earth for rare, unyielding materials. They found raw gold. It did not spoil, was easily divided, was instantly recognizable, and perfectly answered all 5 criteria of a functional currency. Money emerged not as a grand design, but as a series of incremental technological shifts. Each new proxy was a resilient response to trade friction. If you wanted to trade in the ancient world, you dealt with constant friction. You might arrive at a market with a sack of barley, only to find the person selling tools wants animal skins. Or worse, your barley rots before you can trade it, and the cattle you plan to barter suddenly die. Beyond the physical hassle, there was a deeper psychological bottleneck. When a stranger arrived offering goods, you had no way to verify the quality or weight of what they held. Every transaction required blind faith. Around 600 BCE, a small kingdom in modern-day Turkey stumbled onto a solution. The Lydians sat atop a geographic lottery ticket, local river sands rich in electrum, a naturally occurring mix of gold and silver. They learned to extract this metal and shape it into small, perfectly consistent pieces. By standardizing the size, they guaranteed the weight. To prove that weight and purity, the Lydian kings stamped the metal with an official mark, the roaring head of a lion. This physical object solved the communication gap between strangers. If 2 merchants held coins stamped by the same king, they instantly possessed a shared language of value. You no longer needed to vouch for the person standing across from you. You only needed to trust the metal in their hand. By mass-producing confidence, the Lydians removed the friction of barter. They laid the physical and psychological bedrock for a functioning market economy. The Lydian concept leaped across borders almost immediately. Precious metals possessed physical traits that earlier forms of money simply could not match. This chart shows why metal won out. Unlike cattle or crops, gold and silver do not decay. You can carry a small fortune in a pouch, and you can melt and divide the metal perfectly without losing any of its inherent value. No civilization weaponized this technology quite like Rome. They took the concept of standardized metal and scaled it into a massive commercial machine. At the center of this machine was the denarius, Rome's silver coin. A single unit of measure connected 45 million diverse people, finding merchants in Scotland and Mesopotamia into one cohesive economy, using this exact same piece of silver. It oiled the gears of the entire state. The denarius paid the legions, funded public works, and standardized tax revenue across millions of square miles. Rome proved that standardized currency could bind a global superpower together, but they also proved exactly how fragile that trust was. By the 3rd century AD, constant warfare had drained the imperial treasury. The legions still demanded their pay, forcing emperors to cheat the math. Through debasement, mints replaced the silver inside coins with cheap copper. They looked identical from the outside, but their true value was hollowed out. This graph illustrates the scale of the fraud. The denarius issued by Julius Caesar was 95% silver. Over 300 years, that purity was dragged down a steep, catastrophic curve, eventually hitting less than 2%. Merchants quickly realized the coins they were accepting held almost no silver. To compensate, they demanded more coins for the same goods. Prices skyrocketed, and public confidence evaporated. This was one of the first recorded uses of inflation as a deliberate government tactic. By breaking the trust of their own currency, the emperors pulled a thread that helped unravel the greatest empire in history. That fractured trust in metal money wouldn't be fully restored on a global scale until the 1500s. European colonizers in the Americas uncovered unprecedented silver deposits, most notably in the massive, sprawling mines of Potosi in modern-day Bolivia. The silver pulled from these mountains was struck into the Spanish piece of 8. It flooded international trade routes, becoming the world's first truly borderless currency. The newly formed United States had almost no domestic currency, relying heavily on these Spanish coins. When the U.S. Mint struck the first American silver dollars in 1792, they modeled the weight and the dollar sign directly on the piece of 8. The immense reserves of the New World effectively rebooted global confidence in metal. It provided the raw material necessary to anchor international modern commerce. In the modern era, this confidence was formalized into the gold standard. It was the ultimate institutionalized anchor of economic trust. Under this system, the money in your pocket was quite literally backed by the earth. Every paper dollar circulating in the economy represented a fixed physical chunk of gold secured in a government vault. Pegging paper to metal enforced strict financial discipline on governments. It offered extraordinary long-term price stability for global trade, but this system had a strict physical limit. The same immovable weight that provided stability also acted as an inflexible vice grip on a growing economy. When financial panics hit and people needed money to flow, governments were largely helpless. They could not inject new capital into a struggling system because the money supply was strictly capped by the finite amount of metal pulled from the ground. Standardized metal was an elegant ancient technology that solved the basic human problem of trust. But as the sheer scale of modern commerce outgrew the mines, humanity was forced to abandon the physical weight of gold, setting the stage for a system built entirely on paper.
Imagine taking every tangible asset you've earned, years of hard labor compressed into heavy gold or silver, and trading it for a flimsy piece of paper. On its face, this transaction defies logic. If someone proposed it today for the first time, you would call the police. Yet this trade underpins nearly every transaction in the modern world, allowing wealth to move at the speed of thought rather than the speed of a cart. The physical laws of the universe dictate the weight and density of gold, but they dictate absolutely no value for paper. Currency only works because society has agreed to participate in a psychological illusion. We pretend the paper has value, and because we all pretend together, society functions. Before this illusion took hold, merchants traveling China's ancient trade routes dealt strictly in physical reality. This photograph shows thousands of ancient Chinese copper coins. To conduct standard business, a prosperous merchant might need tens of thousands of these. 1,000 coins weighed more than 8 pounds, making the logistics of basic commerce agonizingly slow and physically punishing. During the Tang Dynasty, the Chinese government offered a practical workaround. Merchants could deposit their heavy metal at an official office and receive a written certificate to redeem their coins elsewhere. They called this fei qian, or flying money. When Marco Polo witnessed the emperor paying for goods with paper during his travels in the 13th century, he recorded it in his journals. His European readers, anchored entirely to the reality of gold and silver, rejected the account as pure fiction. The Europeans couldn't understand that the Chinese had already taken the first crucial step in modern economics. They had decoupled the physical asset from the transaction, trusting that the written document could accurately represent the wealth stored miles away. 400 years later, 17th century Europeans arrived at a similar solution out of necessity. Plagued by constant warfare and rampant theft, wealthy citizens began paying local goldsmiths to lock their heavy coins inside secure, reinforced vaults. The goldsmith handed over a receipt entitling the bearer to withdraw the gold. Soon, merchants realized that carting heavy physical metal across town for every single purchase was a complete waste of time. If everyone trusted the goldsmith, they could simply hand the receipt to the next person as payment. The paper receipt stopped being a claim ticket and started circulating as currency. Society voluntarily removed physical assets from daily trade, laying the groundwork for the modern banking system. As these receipts circulated, the goldsmiths noticed a quiet, mathematical truth. On any given week, maybe 10% of depositors showed up to demand their physical gold. The other 90% sat in the dark, entirely untouched. This animation illustrates what the goldsmiths did next.
Instead of just storing the money, they began lending it out. By holding back a fraction of the deposits, say $10 from a $100 deposit, they could loan the remaining $90 to someone else and charge interest. The borrower takes that $90 and pays it to a merchant, who deposits it in another bank. That bank keeps $9 and lends out $81. The cycle repeats, trickling down until that initial $100 deposit has generated roughly $1,000 in new economic activity. Banks essentially multiply money by issuing credit, but this mathematical engine operates on a single terrifying assumption: that the thousands of people holding those paper receipts will never ask for their original physical deposits back at exactly the same time. When trust falters, that assumption breaks. Depositors rush the tellers to demand their hard assets, creating a bank run. Because the vault only holds a fraction of the total circulating receipts, the mathematical illusion shatters and the bank collapses. The American colonies learned the danger of unbacked paper firsthand during the Revolutionary War. The Continental Congress printed these notes to fund their army, but there was no gold in a vault and no fractional reserve to back them up. By 1779, it took 40 paper dollars to buy what one had bought 3 years earlier. Soldiers refused their pay, and merchants demanded hard coin. This hyperinflation embedded a deep suspicion of government-printed paper, or easy money, so deeply into the American psyche that the phrase "not worth a continental" became a common insult. Despite that early disaster, the Union found itself desperate for funds during the Civil War. They printed a new paper currency with distinctive green ink. These greenbacks were backed by absolutely no physical metal. Their value came strictly from the legal decree of the federal government. This transition exposed the inherent risk of fiat currency. Without a strict gold anchor, the banking system spent the following decades teetering on collapse. Panics in 1873, 1893, and 1907 triggered mass public anxiety, with crowds swarming Wall Street as failing institutions fell like dominoes. Trusting money simply because a government decrees it valid is delicate. For society to tolerate this level of abstraction, the system requires a massive, centralized backstop to catch the banks when the math inevitably falters. In response to these repeated crashes, Congress passed the Federal Reserve Act in 1913. They built an institution projected to be as solid as the marble columns holding up its roof. The central bank was designed to act as the lender of last resort. When regional banks run out of reserves and public panic sets in, the Fed has the authority to flood the system with liquidity, providing the cash necessary to pay out depositors. The Fed's authority is rooted in projecting absolute security. They maintain facilities like this subterranean vault in New York, housing the largest known gold depository in the world. The physical gold reassures the public that the system has a concrete foundation. By projecting overwhelming stability, the Federal Reserve ensures depositors rarely need to test the banks. Their true function is to manage public anxiety, keeping the fractional reserve math running smoothly in the background. Every transaction today builds upon this 1,000-year history of slowly replacing physical weight with pure abstraction. The piece of paper in your wallet contains zero intrinsic value. It is not a claim ticket for a fraction of a gold bar, nor is it backed by any tangible commodity. Our entire economic system rests on the fact that billions of people wake up every morning and choose to honor this shared social contract. Without that collective agreement, the paper is just paper. In October 1929, the American stock market lost nearly a quarter of its value in a single day. Fortunes built over decades evaporated in the time it took a ticker tape machine to print the collapsing numbers. Soon, 12 million Americans, a quarter of the total workforce, were out of a job. Terrified citizens made a rational yet devastating choice. They rushed to withdraw their life savings, demanding the only asset they still trusted: physical gold. But the banking system operated on fractional reserves. Mathematical reality dictated that banks simply did not hold enough gold in their vaults to pay every depositor at the same time. When the vaults ran empty, the doors locked. Between 1930 and 1933, 9,000 banks failed, taking the savings of millions with them and shattering public confidence in paper money. Under the financial rules of the era, the total supply of paper dollars was rigidly tethered to the nation's finite reserve of physical gold. This diagram shows the mechanism of the crisis. To stop the economic bleeding, the federal government needed to inject new cash into the system, but they were legally barred from printing that money because they lacked the physical gold to back it. Unable to expand the money supply, lawmakers were forced to stand by while factories closed, jobs vanished, and the broader economy suffocated. A standard originally implemented to guarantee financial stability was actively starving the American economy to death. By 1933, President Franklin D. Roosevelt realized that to halt the Depression, he had to attack the gold standard itself. He issued Executive Order 6102. The decree made hoarding gold coins and certificates a federal crime, legally requiring Americans to surrender their private wealth in exchange for paper dollars. Tons of gold from citizens' pockets, safety deposit boxes, and local bank branches flowed outward, heavily centralizing inside federal vaults. With the nation's gold supply consolidated under government control, the restraints on the printing press were loosened. Washington could now legally expand the money supply to fund recovery efforts. Stripping the public of physical gold was a massive, highly controversial assertion of federal power, yet it gave the government the flexibility it needed to finally jumpstart a paralyzed economy. A little over a decade later, World War II left the industrial centers of Europe and Asia in ruins. The United States emerged entirely intact, its factories operating at full capacity. Alongside its industrial might, America held absolute geopolitical leverage. Safe behind two oceans, the United States now possessed 2/3 of the world's entire physical gold supply. In July 1944, delegates from 44 nations met at a resort in Bretton Woods, New Hampshire. They had 3 weeks to engineer a crash-proof financial architecture for the post-war world. Britain sent John Maynard Keynes, the era's most famous economic mind, to negotiate on behalf of an exhausted empire. But he was sitting across from an American delegation that held all the actual capital. This network models the resulting agreement. The United States pegged the dollar rigidly to gold at $35 an ounce. In turn, every other participating nation pegged their currency directly to the US dollar. Beyond creating institutions like the IMF and World Bank, the Bretton Woods Conference established a single mechanical truth. The American dollar was now the required language of international trade. That system held for a quarter century, but by August 1971, mounting domestic inflation and foreign debt brought the ultimate anchor to its breaking point. On a Sunday night, President Richard Nixon delivered a unilateral television address. He announced that the United States would temporarily suspend the convertibility of the dollar into gold. The temporary suspension became permanent. Global currency markets descended into chaos as European allies woke up to find the central pillar of the Bretton Woods system entirely dismantled. Looking at the Bretton Woods model again, the final tether to a physical commodity was severed. The global economy entered the era of fiat currency. A dollar was now worth a dollar simply because the United States government declared it by decree. In a single broadcast, the engine of global finance detached from physical metal, relying completely on trust in the American state. But floating a currency on trust created an immediate vulnerability. If the dollar was no longer exchangeable for gold, the rest of the world had no mechanical reason to keep holding it. The solution arrived through quiet diplomatic maneuvering. In 1974, Secretary of State Henry Kissinger initiated a series of secret negotiations with the Saudi royal family. The United States offered the Gulf states a guarantee of military protection and advanced weaponry. In exchange, Saudi Arabia, and subsequently OPEC, agreed to price and export their oil exclusively in US dollars. This map illustrates the petrodollar cycle. Because every industrialized nation requires imported oil to keep its power grids and factories running, they are structurally forced to maintain vast reserves of US dollars to buy it. The paper dollar no longer needed Fort Knox. Its value was now firmly anchored to a universal dependency on fossil fuels, backed by American military supremacy. The terrified citizens of 1929 lined up outside failing banks to demand a heavy metal they could physically hold in their hands. Today, massive cargo ships, international supply chains, and entire national budgets operate on a system with no tangible backing whatsoever. The currency has largely transcended paper itself. The global reserve is now a digital network, with trillions of data points moving across the planet instantaneously. By stripping away the golden chains that once constrained it, the dollar evolved into pure abstraction. It sustains the modern global economy entirely by decree, running on nothing more than enforced trust.
A hand selects a card, taps it against a terminal, and waits for a small beep. In less than 2 seconds, the transaction is approved. Nothing tangible has changed hands. No paper, no coins, just a momentary digital handshake. This chart represents the modern American economy, where 1/3 of all purchases are now executed without physical currency. Money has transitioned from a physical object into a sequence of invisible signals. To understand the speed of that transition, we have to look at 1949, when spending was physically constrained. Accessing money meant visiting a bank during specific hours and waiting for a teller to count out paper notes. That year, businessman Frank McNamara finished an expensive lunch at a New York restaurant. When he reached for his wallet,
he realized he didn't have enough cash to cover the bill. He was forced to wait at the table, humiliated, until his wife could drive to the restaurant and physically hand him the money required to settle the debt. This experience sparked an idea for a single card that could settle bills at any restaurant. It initiated a 70-year effort to remove the physical presence of money and make the act of spending invisible. In 1950, McNamara launched the Diners Club card with 200 customers and 27 restaurants. Within a year, he had 20,000 members. He established a three-party model to bypass cash: the cardholder, the merchant, and a central credit network. This structure still governs global commerce. These nodes multiplied into massive networks like Visa and MasterCard, processing $10 trillion every year. In 1958, Bank of America released Bank America Card. By licensing the card to other banks, they moved this abstract spending power out of exclusive clubs and into the hands of the general public. For the first time, consumers had a tool allowing them to take a product home immediately and pay for it weeks later, a capability previously reserved for those with established credit. Removing the immediate friction of handing over cash changed how people calculated cost. The system was built on the reality that a portion of users would spend more than they currently possessed and carry a balance. This statement shows the mechanics of that profitability. By making spending effortless, the system facilitates high-interest debt, with rates that frequently exceed 20% per year for those who don't pay in full. In 1969, the first American ATM was installed, further reducing the role of the physical bank. Money was now available at midnight without a teller or a branch office. This was the first step in making the bank branch optional, untethering currency from business hours. By the mid-1990s, the internet began to remove geographical friction. Early e-commerce on this Packard ball required users to type credit card numbers into primitive forms and wait days for a delivery. PayPal launched in 1998 with a simple proposition: email money instantly, without a physical card. PayPal's success wasn't a matter of new technology, but of trust. They proved that consumers were willing to hand over sensitive financial data to a machine if the transaction felt safe and convenient. Establishing that trust created the foundation for all virtual finance. It proved that the desire for convenience would consistently outweigh concerns about digital security. In 2007, the iPhone collapsed every remaining financial tool into a single device. Steve Jobs described it as a phone and an internet communicator. He didn't mention its future as a digital wallet, eventually consolidating almost every stage of a consumer's financial life into a single interface. From a couch, a user can now pay a rent, invest in stocks, apply for a mortgage, and tip a driver through instantaneous digital gestures. This graph shows the result of that convenience. In the year 2000, 70% of consumer purchases involved cash. By 2023, that number dropped to less than 20%. The physical dollar bill, a staple of American life since the 1860s, is becoming a relic of a previous era. The smartphone didn't just digitize our currency, it removed the last physical barriers to human commerce. Apps like Venmo and Cash App added a final layer to this abstraction by making the exchange of money social. For younger generations, moving money became a public act. Transactions now appear in feeds with emojis and jokes, turning a financial settlement into a social interaction. The scale of these payments is now massive. The annual volume of money moving through these peer-to-peer apps exceeds the gross domestic product of most nations. But this level of efficiency has a quantifiable cost. Americans now hold over $1 trillion in credit card debt. When spending is reduced to a thoughtless digital reflex, overspending becomes difficult to avoid. The psychological friction that once came with handing over physical cash has been completely engineered out of the system. The 70-year journey from McNamara's wallet to the smartphone has been a steady movement away from the tangible. Each step required more trust in the digital systems that manage our value. As money becomes pure code, the central question is no longer about the convenience of the transaction. The focus is shifting to a matter of authority. Who actually controls the digital infrastructure that governs our wealth? In the fall of 2008, scenes like this became the defining image of a global financial collapse. Major banking institutions failed, taking public confidence down with them. Behind the headlines, the reliance on those banks exposed a mechanical vulnerability in how we handle digital money, rooted in the double spending problem. Physical cash cannot be copied, but digital files are easily duplicated. To guarantee that a digital dollar is spent only once, the system required a centralized middleman to verify and record every transaction. When those middlemen fail and require taxpayer rescues, the entire digital economy faces paralysis. The breakdown in 2008 created a sudden demand for a system that functioned without them. On Halloween night in 2008, a 9-page document appeared on a cryptography mailing list, authored under the pseudonym Satoshi Nakamoto. It outlined a peer-to-peer electronic cash system. 2 people, anywhere on the planet, could transfer value directly without relying on a bank, a corporation, or a government. Satoshi Nakamoto embedded a newspaper headline about bank bailouts into the very first block of code, marrying the software to the specific financial failure it was designed to resolve. The technical engine driving this system was the blockchain, a solution to the double-spending puzzle that replaced human oversight with mathematics. Instead of keeping a master ledger in a single corporate vault, the blockchain operates as a transparent public record. Millions of computers around the world hold a perfect synchronized copy of every transaction. As new transactions occur, they are mathematically tethered to the ones that came before, forming an unbroken chain of data. To falsify a record, an attacker would need to simultaneously overpower more than half the computing power across the entire global network. Humans have recorded financial data for 5,000 years, but always through custodians. This created a ledger that exists without a human administrator to compromise. In practice, the adoption of this code started as a niche experiment. In 2010, the first known commercial transaction took place when a programmer bought 2 pizzas for 10,000 bitcoins. That transaction preceded a decade of extreme price swings. The value moved from fractions of a penny to tens of thousands of dollars, punctuated by sudden 80% crashes. This volatility created a functional hurdle. Money requires stable purchasing power to be useful in everyday commerce. You need to know your currency will hold its value from one day to the next. Because the software permanently caps the supply at 21 million coins, Bitcoin moved away from its role as a currency and became a highly sought-after, unprintable asset class dubbed digital gold. The attempt to engineer a stable medium of exchange resulted in a wildly speculative, inflation-resistant store of value. While Bitcoin established digital scarcity, programmer Vitalik Buterin expanded the technology with a platform called Ethereum. Ethereum introduced smart contracts, lines of code that automatically execute financial agreements. Escrow, lending, and trading could now happen mechanically, without lawyers or brokers. By 2021, hundreds of billions of dollars were flowing through these automated protocols, creating a parallel financial system. But an ecosystem stripped of traditional regulatory guardrails quickly attracted human exploitation. Centralized exchanges operating within this space committed massive fraud, culminating in the collapse of FTX and its founder, Sam Bankman-Fried. A mathematical framework built to remove human trust from the equation ultimately suffered its deepest losses due to old-fashioned human greed. Measured, the traditional financial establishment responded by studying these underlying mechanics and digitizing their own fiat currencies. The result is the central bank digital currency. It offers the speed of a blockchain transfer, but remains entirely issued and controlled by the state. As seen on this interface, China has already deployed its digital yuan to hundreds of millions of users. Globally, governments representing 98% of global GDP are now exploring these digital assets. The anonymous effort to bypass government control provided the technical architecture for the state's own digital currency. Meanwhile, the institutions the 2008 white paper sought to bypass began acquiring the asset. By early 2024, the Securities and Exchange Commission approved Bitcoin ETFs. The asset was formally packaged, regulated, and sold by massive managers like BlackRock. The traditional financial system integrated the technology, absorbing the capital into existing regulatory frameworks. Regardless of institutional adoption, individuals can now hold an asset where the supply is governed by code rather than central policy. In Stockholm, the checkout counter at a local cafe rarely sees a physical coin. Less than 1% of transactions in Sweden are made with cash. But cross the ocean to a diner in rural Appalachia, and the card reader disappears. Here, dollar bills are counted out by hand. The transition to digital money is happening, but the pace is deeply uneven. Roughly 15 million American adults operate entirely outside the traditional banking system. Without a checking account or a smartphone, they rely on storefront check cashers and physical paper to pay their rent and buy their groceries. For these citizens, physical cash is a daily requirement. Eliminating it entirely would lock them out of the economy. Yet there is a generation of Americans growing up today who have never broken open a piggy bank or handed cash to a cashier. For them, money has always been invisible, a changing number on a screen. Moving away from paper forces us to look closely at the system replacing it. And doing so reveals an uncomfortable reality about our economy. Money has no intrinsic physical value. The paper and the metal that we carry around are just props. To understand the digital networks that will soon govern our transactions, we have to accept that money works precisely because we all agree to believe in it. Money is a technology designed to record social obligations. When you hand someone a bill, you are giving them a claim on society's resources. For thousands of years, communities across the globe used cowrie shells to track these obligations. The shells worked perfectly, strictly because the people trading them collectively agreed they held worth. The modern dollar relies on the exact same psychological mechanism. It functions because hundreds of millions of people trust the institution printing it. If that collective trust breaks, the value evaporates instantly. Because money relies entirely on this shared social contract, changing the form of our currency means rewriting the rules of our society. The United States Federal Reserve is currently studying the potential for a digital dollar. This central bank digital currency would exist entirely on government ledgers. This system allows value to move instantly from a central bank directly to citizens, bypassing commercial banks for immediate payments. But this architecture gives the government a complete, real-time record of every transaction. There is nowhere to hide income or spending. This level of control introduces the possibility of programmable money. Authorities could code funds to expire if not spent quickly to stimulate the economy, or block purchases in specific categories. This is not a theoretical concept. China has already deployed the digital yuan, integrating similar programmable features into its active financial markets. A centralized digital dollar offers the promise of incredible systemic efficiency, but it requires citizens to surrender their ultimate financial privacy. While central banks study digital currencies, the corporate sector is quietly handing the management of wealth over to artificial intelligence. When you swipe a credit card or apply for a mortgage, algorithms assess your fraud risk and score your credit history in fractions of a second. We are rapidly approaching an era of autonomous finance. Soon, AI agents acting as personal financial officers will independently negotiate insurance rates, time bill payments, and execute investments while you sleep. Cautionary: handing over this level of control risks embedding algorithmic bias into our daily lives, further concentrating wealth within the few technology monopolies that build and train these systems. The path away from physical cash splits into two distinct risks. Central bank currencies demand we trust the state with our privacy, while autonomous finance demands we hand our agency over to algorithms. The underlying rules of money have never been politically neutral. Early global financial networks were engineered to extract immense wealth through colonialism and the brutal enforcement of forced human labor. This postal map of Birmingham, Alabama, illustrates how domestic policies enforced segregation. The color-coded boundaries were drawn specifically to block access to credit, purposely designing the racial wealth gaps we see today. Today, that historical extraction has been replaced by the blinding speed of modern financial institutions, which consolidate massive capital in microseconds. These systems do not evolve organically by accident. They are intentionally designed to include a select few, while extracting value from everyone else. Right now, a fully programmable global digital network is being wired together to replace the bills in our wallets. We are living in a brief, fleeting window where the architecture of this new system can still be shaped. We will either hard code our historical inequalities permanently into the digital ledger, or we will use this transition to build a framework for actual economic equity. Because money is nothing more than a shared story, it ultimately reflects what we value and who we choose to protect. The physical dollar will fade away, but the human consequences of the digital systems we choose to replace it with will last for generations.